Okay. Uh, Hello, my dear friends. Very good morning to all of you. We are starting 15 minutes early today. I hope you are prepared for it. Uh, First, we'll start with share-based payments, and then we'll go to financial instruments. We'll go up to 215, 220, and depending on that, we'll see to what extent we can complete. Our focus will be on share-based payments first, and then we go for the financial instruments. Please confirm me that my voice is fine and you are able to see the PPT correctly. Can you please confirm it? Okay, so things are fine. Let us go into the share-based payments. Share-based payments is very simple actually. What you need to understand is overall concept first, and then you should be able to understand the calculation part of it. And for calculation part, just like consolidation, for share-based payments also, I am going to give you a beautiful tabular format. If you're comfortable with the tabular format, every problem, anything may be the adjustment, you can solve it using that tabular format. Okay, let us go ahead with it. I hope old syllabus and new syllabus people are there. Both of you can join. I'll tell you what is the difference. You just need to make a note of it. Otherwise, both old syllabus and new syllabus students can attend this session today. Okay, now let's go to the share-based payments basics. Whenever an share-based payments, or we popularly call it as ESOP, comes, you have to understand these three terminologies. One, the announcement date, the date on which it is communicated to the employees. Second, the date on which condition is satisfied. And third, date on which option is exercised. Option is exercised. So once an announcement is made by the employer, it will not be given to every employee. They need to satisfy certain conditions. That date on which it is satisfied, we call by certain name. And then once they are eligible, they can exercise it. Okay, the date on which the announcement is made is called as grant date. The date on which the condition to be satisfied is called as vesting date. So once, like, the condition may be that you have to work with a company for 5 years. So 5 years is, once you completed, the date on which you complete is called as vesting date, and the options are said to be vested. If you leave within that, here the options are called as unvested options. Then once you are vested, you get the eligibility. Once you get the eligibility, you go and exercise your option. The time period within which conditions are satisfied is called as vesting period. The time period within which the employee is exercising his option to buy the share is called as exercise period. Then vesting period is the period in which the employee works and employer get the benefit. Okay, so the benefit what employer is getting is the service of the employee. The benefit that employee is getting, what does he get once he completes this vesting period? What he gets, he get the option, he get the benefit of exercising. For example, every employee is given 100 shares where they can purchase the share at 30 rupees, whereas market price is 40 rupees. So 30 rupees is the price at which employee can exercise, but market price is 40 rupees. 10 rupees the concession, benefit, discount the employee is getting. So the benefit employee gets is the difference between what others get and what you get. That concession is employee benefit, and employee works, so that service is what employers benefit. So as per matching principle, the benefit and the cost should be recognized in the same period, and therefore in the vesting period, the benefit what employee is getting should be recognized as expense from the point of view of employer. Now the question comes, if 30 rupees, 40 rupees the difference, for example, as on grant date, the market price of the share is 40 rupees, but option price, exercise price, where employee will be eligible, not now, later, is 30 rupees. The difference, 10 rupee, is called as intrinsic value. If you know the options in the SFM, you will be able to connect it better. That is, the difference between market price and strike price is called as the intrinsic value. But when will you get this benefit? You don't get this benefit today. You get this benefit only on date of condition exercising. No, only at the time of actually you are exercising your option, not in the vesting period, but in the exercise period. Anyway, keep it aside. But the point is, it will happen at a later point in time. So the concession is obtained at a later point in time. But you have to start accounting from the grant date till the vesting date, that is during the vesting period. So during the vesting period, the expense has to be recognized, where the benefit for employee will happen later. So there is a time gap. And how do you account for time gap? You do a present value of it. That is what is called as value of option, fair value of option. You may compute under binomial model, you may compute under Black-Scholes model, or any other fair valuation model. But that is not part of FR. In the examination, they will give you the fair value. So essentially, what is the difference between intrinsic value and fair value? Intrinsic value is difference between market price and strike price. Fair value is considering the market price and strike price, and also the present value of it, and many more other aspects. The old syllabus students, guidance notes, you have a choice. Either you can follow fair valuation approach, or you can follow intrinsic value approach, intrinsic value on grant date, fair value on grant date. Both or either of them you can choose as an accounting policy, old syllabus students, as per guidance note. As per new syllabus, only fair value. Ind AS people are completely on fair valuation approach. That is the foundation principle of IFRS Ind AS. So Ind AS 102 only talks about fair value. Guidance notes gives you a choice, either an intrinsic value or a fair value. Since both set of students are there, since both of you must be right, I will be solving the problem only on fair value. So old syllabus also this is correct, new syllabus also this is correct. Okay, hope things are back, my dear friends. Is things are clear now? Okay, fine. Internet is really not in my control. I'm doing all things I can. I'm moving here and there. I tried at home, I tried at other places. I've come to the studio now. Here also internet is continuing. I can't help. I try my level best. Worst case scenario, if lot of things are getting stuck in between, what I do after the session is over, I will re-record it and I will upload it on the YouTube. So in case if things are not recorded properly, I will redo it again once more, no issues. Let us hope for the best. Let us continue. So what I was telling, during the vesting period, the employee works, employer get the benefit. Therefore, during the vesting period, the expenses will be recognized. But when the expenses will be converted into share capital, because shares are issued to the employee, they become shareholder. So when will they become shareholder? Only when they exercise their option. When it will happen? During exercise period. Okay, so during vesting period, expenses recognized. During exercise period, once the employee actually exercises, money is received from the employee, and the discount whatever given so far accounted, both of them put together will get transferred to the share capital or security premium proportionately, as the case may be, depending on the amounts. But hope you got the overall structure. In the vesting period, expense is recognized, which is the difference between the market price of the share and the uh, the price at which the employee can exercise. Okay, so hopefully that is clear, and once the point is exercised, you are going to convert into share capital. That is the foundation. Let us go into the types. Some of you are telling synchronization problem. My dear friends, is it fine? I am not seeing any error here. Okay, I think things are fine. Okay, let's go further. Okay, share-based payments, broadly, there are employee stock option plan where things are immediately recognized. There is no concept of vesting period. They will give you a spot offer. Hey, you are a good employee. Take this share or leave it. No conditions. When there are no conditions, expenses are immediately recognized provided employee accepts. Employee stock option plan, that is where we need to discuss more. Issue of shares at exercise price, proportionate expense, as I explained, is recognized in vesting period and it will come in the balance sheet as equity. And then the second variety is stock appreciation right. Stock appreciation right means instead of giving the shares to employee, we will give him the benefit directly in cash. That is, if market price is 90 rupees and option price is 75 rupees, his benefit is 15 rupees, his concession is 15 rupees, that 15 rupees is paid in cash. So employee stock option settlement happens in shares, so it is an equity element, whereas stock appreciation right, the amount is paid in cash, therefore it is treated as a debt liability. So in ESOP, settlement happens in shares, so it is an equity element. In stock appreciation right, settlement happens in cash, so it is a debt element. Then third method is there where ESOP with cash alternative, where employee can choose either to receive the money in cash or he can settle by way of shares. So this is a typical situation of compound instrument because it can be settled in equity or it can be settled in debt depending on or at the option of the either employer or employee, that may be decided at a later stage. Because there is a debt component as well as equity component, technically financial instrument wise it's called as compound financial instrument, and we need to separate the element, and that is also we going to do a problem, but you understand debt component and equity component. Okay, now one more important point here. Now employee stock option plan, we will recognize fair value on grant dates. Fair value on grant date. If let's say it was 50 rupees and year end, if it is 55 rupees, are we going to change the fair value? The answer is no. Fair value on the grant date is continued till settlement. In which case? In case of ESOP, equity, because equity is the nature such that once recognized will not be remeasured. I repeat, equity is such a nature that once measured will not be remeasured. For example, company issues equity shares. They record it as bank account, to share capital, to security premium. Next day, share price changes in the stock market. Do you think the company will account the share price changes in the equity element? They don't. So equity element once recognized, unless under exceptional cases, are not remeasured. Similarly, ESOP in the nature of equity once recognized on grant date is not remeasured related to fair value. Number of employees expectation may change. I'll come to that. Whereas stock appreciation right, if 50 became 55, stock appreciation right 50 became 55, there that is a debt element, and debt element fair value change means your obligation also will change. Therefore, for stock appreciation right, you need to change it. So just to summarize it, the element related to ESOP is recognized on fair value on grant date and not remeasured. Whereas stock appreciation right in the nature of debt, fair value is remeasured because it is in the nature of debt. Keep the basic principle in mind. Equity elements, once recognized, are not remeasured usually. Debt element, once recognized, are remeasured on fair value basis. General principle, thumb rules. Okay, so you have to divide into debt component and equity component proportionately on debt element and equity element. That one problem also we will handle. Okay, now coming to the computation part. Now, let's take either stock option or stock appreciation right. Let's say one of them. As on the grant date, 1,000 employees were there. And first year end, 950 employees were there. Now, should you take 1,000 employees and recognize expense for them, or 950 employees and recognize expense for them? The answer is neither of these two. Because grant date employees 1,000, that is starting point. Year end 950, that is middle point, that is during the vesting period. But what do we want? How many employees who are expected to satisfy the condition? How many employees who are expected to satisfy the condition means we will not take 1,000, we will not take 950. At the end of vesting period, how many of our employees are there? Let's say 900, and we don't know the future. Only the person who knows future is astrologer, but we can't ask him such things. We can these things and all we cannot ask with astrologer. So what do? Management expectations, management estimates are used. So at the end of every year end, management should give in the examination, the exam questions will give how many employees are expected to satisfy the condition, how many employees are expected to vest at the end of vesting period. For those number of employees, you are going to recognize expense. For example, in this case, let's say 900 employees are expected to satisfy, one share each, and the fair value happens to be, let's say, 10 rupees. For convenience, that is 9,000. And suppose vesting period is 3 years, therefore, first year you do 9,000 divided by 3, that is 3,000. No concept of present value here. Why no concept of present value? This fair value 10 rupee itself is present value. So you can't do present value 2 times, duplication. So we just divide by 3, simple amortization. That's how we are going to get the annual expense. Now when it comes to second year, suppose 900 employees become 800 employees. Then what do? Same thing, 800 into 10, let's say not 800 for convenience sake, let's say it becomes 600 for simplicity calculation. So 600 into 10 divided by 3, that is 6,000, by 3 means 2,000. Perfectly fine. But one problem is there. What is that problem? Previous year, we have recognized 900 employees. Out of 900 employees, it became 600, means 300 employees expense already recognized, now need to be reversed. 300 employees for whom the expense recognized in the first year is already recognized. That needs to be reversed. How do you do it? 300 employees into 10 rupees into 1 by 3, that means 1,000 rupees need to be reversed. But when things are getting changing in multiple factors, this mode of settlement will become difficult. Instead, what do? We compute what is supposed to be the closing balance, we compute what is the opening balance, and balancing figure we get it as current year expense. Like in this case, 600 into 10, that is a total expense. How many years have been completed? 1 year is over and 1 more is over. Therefore, closing balance will be 6,000 into 2 by 3. Number of years completed divided by total number of years, which is in this case 4,000. And what was the opening balance? Opening balance here, previous year balance was 3000. So current year expense will be 1000, which is what in our method also 2000 expense, 1000 expense reversal, net 1000 expense. So instead of computing expense for the year, what do? We will compute the closing balance and compare it with the opening balance, and difference will be current year expense. My dear friends, if you remember, we have done this formula in business combination yesterday. Share based payments, replacement award. What is the formula we have done? Fair value of the original award multiplied by the vesting period completed divided by original vesting period or new vesting period, whichever is higher. Correct? This is the logic. Essentially, there we are calculating the closing balance of the option value. Okay, now let us go for the problem. Along with the problem, let us also discuss the format. Fine. So I'm taking the problem, which is a recent RTP MTP question only, so we can do based on that. Let us do a problem. An entity which is follow financial year end as per the calendar year grants 1000 share appreciation rights to each of 40 management employees on 1st January 2005. The SAR provides the employee with the right to receive at the date when the rights are exercised cash equal to appreciation in the entity share price since the grant date. So this is a case of SAR, stock appreciation right, which means this is a case of debt element. What is the basic difference between debt element and equity element? In debt element, the fair value at the end of every reporting period is changed. Whereas in equity option, whatever the fair value on the grant date is continued without remeasurement. But in both the cases, number of employees may change depending on the management estimations. Let's go further. All rights vest on 31st December 2006. They can exercise during 2007-8. Management estimate that on grant date the fair value of SCR is rupees 11 and estimates that overall 10% of the employees will leave during the 2-year period. Please remember, overall 10% of the employees will leave. Remember, overall, it is not per annum. Sometimes they say 10% per employee shall leave, 10% per annum annually. So when they tell you, you have to do number of employees on grant date into 90%, that is remaining 1 minus 10%, into 90% into 90% if the vesting period is 3 years. But here they said overall 10%. So just multiplying one time 10% is sufficient, don't do 3 times. It is estimated overall 10% of employees will leave during the 2-year period. The fair value of SAR at each year end as below. 31st December 2005, 2006, 2007, 2008. 10% of the employees left before the end of 2006. That is what is your expectation was. So everything happened as per expectation. On December 2007, when the intrinsic value of SAR was 10 rupees, 6 employees exercised their options and the remaining 30 employees exercised their options at the end of 2008 when the intrinsic value of each SAR was equal to fair value of 12 rupees. How much expense and liability to be recognized at the end of each year was journal entries. Okay. Let me give you the format. Okay, this is the format. Listen to me carefully, then you can take it down. First, we will write number of employees who are expected to satisfy condition. So year 1, year 2, year 3, year 4. How many years it may be? You keep writing it in the number of columns. Number of employees you expected to, which can change every year. Okay, options per employee. Every employee can become 100 options, 50 options. It can also change every year, but usually remains same. Fair value per option. If it is in the nature of equity, that is remaining same. But if in the nature of debt, this will change every year. But format is same. Total expense in the vesting period. How do you get? Number of employees multiplied by options per employee and multiplied by fair value per option. This is the total expense in the total vesting period. Then we compute what is the expected vesting period, which can also be fluctuating. Then closing balance. How do you get the closing balance? total vesting period multiplied by vesting period completed divided by expected total vesting period. How many years are over? Divided by total number of years. Just like the way we have done in business combination. The fair value of the option ESOP multiplied by vesting period completed divided by total expected vesting period will give you the closing balance. Subtract opening balance, you get the current year expense. Any problem, debt, equity, debt with equity alternative, ESOP, SIR, cash alternative, be it any problem, this format works. Simple, logical, structured tabulation. Examination, first try to get this structurally understood, then solve the problem so many times or so many problems such that this format is set in your brain like a picture. So you don't have to by heart it. You solve more number of problems, format comes. The key in FR is only this, my dear friends. For some theory topics, charts, and for some problems like consolidation and for share-based payments, tabulations. If you are comfortable with the formats and the charts, FR is taken care. Same thing has been to SFM also. Anyway, let's do a problem here now. In this case, okay, now in this case, what is the vesting period and what is the exercise periods? 1000 share appreciation rights to each of 40 employees on 1st January 2005, grand day. And you will get the cash equal to appreciation, all right, vest on 31st December 2006. So 1/1/2005 to 31/12/2006. So this is the vesting period. Then you can exercise in 2007-2008. So till 31st December 2008, that becomes the exercise period. Let us fill it up in the table. So first I will write 31st December 2005. December 2005. Then 31st December 2006. Then 31st December 2007 and 2008. How many ever number of years are there? You can have those many number of columns. Now number of employees expected to satisfy the conditions. Number of employees who are there are, how many were there? 40 employees. 10% of them will leave. So, and overall not 10% per annum. So what do we do here? 40 into 90%, that is 36. They said 10% overall. Had they said 10% of the employees shall leave annually, what you would have done? 40 into 0.9 into 0.9. Or how many ever number of employees left in the current year multiplied by 0.9. Anyway, all these are expectations. Expectations cannot have rules. Okay. Now, 36 options per employee. What is the options per employee? Each employee will get 100. And what is the fair value of the option? Not on grant date. This is debt element. So at the end of the year, what is the fair value at the end of the year? At the end of the year is 12 rupees. And total expense in the vesting period, multiply all the three, that is 36 into 100 into 12, that comes to 4,32,000. Then expect vesting period 2 years, and closing balance will based on number of years completed. 4,32,000 into number of years completed 1/2, that is 2,16,000. Then opening balance, first year there is no opening balance, 0, and entire amount will become current year expense 2,16,000. Okay. I don't think any lagging is happening. I think things are working fine. Okay, maybe I have not shared it. I'm sharing it once more. If you are not able to see, I'll repeat it. So 40 employees, 10% of the employee will leave. So 90%, 100 options per employee, multiply 46 into 100 into 12, that is 4,32,000. Vesting period 2 years, out of which 1 year is only over. So 4,32,000 into 1 by 2, opening balance is 0. So current year expense is 2,16,000. Some of you telling solution is not visible. Can you see it now? Please confirm. Okay, options per employee is 1,000. So 1,000 I'll multiply. But I hope numbers are fine. 4,32,000 is the number. Okay. Next year, no change in the number of employees have happened. So that will continue to be 36 only. And this also continue to be 1,000. But fair value changed. How much is the fair value now? Fair value at the end of the year is 8 rupees. So 8. What is the closing but total expense then? 36 into 1,000 into 8. That is 2,88,000. Expected vesting period is 2 years. Which is remaining same. And closing balance will be 2,88,000 into 2 by 2. And that is 2,88,000 itself. Opening balance is previous year closing balance, which is 2,16,000. So balancing figure comes to 72,000. Okay. Now, this is the first year, second year, vesting period is over. Now we'll come to the next years. Remember, how many employees have actually exercised? Again, as per expectation, not exercised, vested. 36 employees have vested their options. Now, out of 36 employees, how many employees have actually exercised? That is what is going to happen next. What is the information given? 6 employees exercise their options, and the remaining 30 employees exercise their option at the end of 2008. So December 2007, 6 employees exercised, and at the end of 2008, remaining employees also have exercised. Okay, so what will happen now? Okay, what is the fair value at the end of the year? 30. So again, I'll say 36 employees, options per employee 1,000, fair value per option, which one will I take? Now fair value per option will be, I'll take it as not 8 rupees. Fair value per option became 13 rupees. No, at the end of 2007, when the intrinsic value of each SAR was 10 rupees. Okay, so this you have to be careful slightly, because there are two kinds of fair value here, for the people who have exercised and for the people who have not exercised. For the people who have exercised, the fair value is 10 rupees, and for the people who have not exercised, for them fair value will be 13 rupees. So I'll write it two things here. One is 10 rupees, another is 13 rupees. So what will be the expense you are going to consider? 36 employees. We have to do number of employees wise. How many employees have exercised? I think 6 employees have exercised. 6 employees exercise their option, and number of 1000 is each of the employees into, when they exercise, the fair value is 10 rupees, which comes to 60,000. And okay, I'll just write the amounts later, plus the other employees, remaining employees. Who are remaining employees? 30 employees, 1000 option each. And what is the fair value of their option, because they are not exercised yet? That is 13 rupees. So total, can you give me the total, somebody? This is 60,000 and 30 into 1000 into 13. 4,50,000. Is the number correct? 4,50,000. Please confirm. Yeah, 4,50,000. Thank you. Now, years is 2 years. 2 years is already completed, so no need to do any other calculation. So you can simply do 4,50,000 into 2 by 2, that is 4,50,000. Opening balance is previous year closing balance, which is 2,88,000. And please tell me the difference. 4,50,000 minus 2,88,000. What is the difference, my dear friends? 1 lakh something. Can you give me difference? 4,50,000 minus 2,88,000. 1,62,000. Fine. 1,62,000. That is a current year expense. So any complication, let them give. Somebody exercise, somebody not exercise, something has lapsed. All the things will fit into this format. Very simple format. Okay. Anyway, let's go to the last one. Now, last year we can't have 36 employees because 6 employees have already exercised. Remaining 30 employees. Have all the exercised? Remaining 30 employees exercised. So 1,000 rupees option, and what is their fair value? That depends on the intrinsic value when they have exercised. When the intrinsic value of each SAR was equal to 12 rupees. So here we take 12 rupees. So this amount will be total expense 30 into 1000 into 12, that is 3,60,000. Okay, then 2 years, 3,60,000 into 2 by 2, that is 3,60,000. Okay, opening balance, my dear friends, you have to be careful little bit here. Here, only one thing to be careful is in this period, opening balance, don't take 4,50,000, because 4,50,000 is for entire 36 employees, but we are taking 30 employees only, and 30 employees, what was our calculation earlier? 30 employees, this was a number, right? I'm just highlighting it. So only that number you should take it as opening balance, that is 30 into 1,000 into 13, 3,90,000. So minus opening balance is 3,90,000. Therefore, this will be a reverse period 30,000. That is negative. It will be right back to P&L account. That is your solution. Let us look at any questions here. One doubt, 2007 is exercise period. Now we're not vesting period. Yes, exercise period, but in exercise period also, when the options are not exercised, pending exercising, fair value change need to be accounted. Change in accounting estimate. That's why. The logic behind intrinsic value when the exercise is that it's actual expense to the company, correct, because that is the actual payment that is on the date of exercise. Whatever is the intrinsic value, that is the amount paid by the company. So that should be considered for all our accounting purpose. Sir, could you explain the difference between fair value and intrinsic value again? Logically, fair value and intrinsic value is difference between, how do you say, in options. Option market price minus strike price is called as intrinsic value, and if you do a present value of it, that is called as fair value. So present value of intrinsic value is called as fair value. Anyway, you don't worry about it. What you need to do for accounting purpose, as on the date of grant date and every year end, you revalue based on fair values. But when the actual payment is done to the employees, that will be the difference between market price, strike price, which is what they've given intrinsic value. Take it as a payment amount. That's it. Okay, so they've asked for journal entries. You please take care of the journal entry part. You can, that is a institute solution. You can just go through it. I'll share it here. But calculation was the most important part. In general, can you please explain the acceleration concept? I'm not sure what is that acceleration concept means. I just know difference between closing balance minus opening balance. Only in SIR we account in fair value change till exercise and not in ESOP. Correct, absolutely correct. Only in SIR we account for fair value change till exercise. And on the date of exercise, they don't call fair value, they call it as intrinsic value. Okay, on that, just the terminologies, don't worry too much, but your point is correct. Only in SIR it is a fair value change till the date of exercise. Perfectly right. Okay, journal entry wise, I'll show it to you, institute solution only. I don't think I need to explain anything much over there. This is the institute solution. So first year you go for 2,16,000 expense, second year 72,000 expense, third year payment of 1,62,000, payment of 60 and expense recognition of 1,62,000 that is being transferred. Then 30,000 is the reverse and 3,60,000 is the payment. So this journal entry part, I don't want to go into it. Institute solution is there, you can go for it. I'm again getting the difference, asking the difference between intrinsic value, fair value. Intrinsic value is difference between market price and exercise price. The present value of that is called as fair value. The thing is, it is not required for exams. I don't know why people are getting confused. On the grant date, at the end of every year, you should go for fair value. At the time of settlement, for the purpose of payment, you go for intrinsic value. That's all. Okay, I think we can go for the next problem. Okay, let me go for the next problem. Question number 2. Sir, cancellation of option. If the option is not exercised, instead of writing SIR to cash, you will write SIR to general reserve or SIR to retained earnings. Instead of transferring payment to cash, you will transfer it to general reserve. That's all. In case any people did not exercise. Okay, let's go further now. Question number 2. An enterprise grants to an employee the right to choose either cash payment equal to fair value of 1,000 or 1,200 shares. I'm getting one more question. Let me just answer it. In the ESOP, intrinsic value is entirely ignored because accounting for options on vesting periods. Correct. That is what I'm telling. Fair value is considered for equity purpose on grant date, no remeasurement. Whereas for the SAR, fair value is considered for remeasurement every year, and at the time of payment, intrinsic value is considered. And remember one more thing. At the time of settlement of SAR, intrinsic value and fair value both are equal. Because what I told you about fair value is present value of intrinsic value. If I am calculating on the same day, today intrinsic value, today fair value, no time value of money concept, both are equal. So in altogether, you just consider for the purpose of exam, even if they give intrinsic value, you read it as fair value. Your problem is over. Equity, ESOP, it is not remeasured. Debt, SAR, remeasured until settlement. Even if they give intrinsic value, you read it as fair value. Your problem will be solved. Okay, good. Let's go further. An enterprise grants 1,000 employees right to choose 1,000 shares or 1,200 shares. Okay, this is an interesting question. They will tell you either 1,000 shares or 1,200 shares. If somebody gives you, do you want 1,000 chocolates or 1,200 chocolates? You will tell 1,200 only. If somebody gives you the option 1,000 shares or 1,200 shares, you have to choose 1,200 shares only. So that is not the intention behind this sentence. These cash payment equal to 1,000 or 1,200 shares. So if you choose 1,000, that is cash. If you go for shares, you get 1,200 shares. Don't add that sentence cash to both the parts. I know in English, whenever we use the word and or, the prefix has to use for both parts in the sentence. But you have to understand from the context. So if somebody says, behind every successful man, there is a woman. If you want more success, not more women, more hard work. So you have to understand from the context of the sentence. Law of reasonable interpretation. So here the interpretation is 1,000 shares if you want cash settlement, 1,200 shares if you want share settlement. So this is a case of ESOP with cash alternative. It's a hybrid instrument. Debt component is there, equity component is there. Grant is conditional upon completion of 3 years of service. If the employee chooses the equity alternative, it must be held for 3 years after vesting date. Suppose if you have a share, some kind of conditions are there. It's called as a lock-in period. The face value of the share is 10 per share. On the grant date, fair value of the share of the enterprise without considering post-vesting restriction is 50 per share. At the end of year 1, 2, 3, the set fair value is 52, 55, 60 respectively. Enterprise does not expect to pay any dividend in the next 3 years. After taking into account the effects of post-vesting transfer restrictions, the enterprise estimate the grant date fair value of the equity alternative is 48 per share. At the end of year 3, employee chooses scenario 1 cash alternative, scenario 2 equity alternative, calculate the amount of expense for each year and pass the entries for each year and for settlement under 2 scenarios. Okay, now as I told you, this has debt component, equity component. So first you should calculate the separation of that, then we go for regular accounting. So what is the total proceeds kind of thing if you compare with financial instruments? If you go for 1,200 shares, what is the fair value per share? Because if you go for share, some sort of restrictions are there, and with restriction it is 48. So 1,200 into 48, that is the value if you go for shares. If you go for cash settlement, you get 1,000 shares and the value per share is 50 rupee per share. Okay, this is one way of understanding it. Other way of understanding it is simple logic. You don't get double benefits. What is that? Either you get more number of shares or you get more value per share. You can't get more number of shares also and more value per share also. Double benefit you don't get. So when you have more number of shares, value per share will be less. When you have less number of shares, value per share will be more. That is one more cross verification you can do while doing calculations. Okay, so keep this in mind. What will be the value? So if you go for equity settlement, it is 57,600. If you go for cash settlement, 50,000. The difference will be called as equity component 7,600. Now 50,000, if employee chooses, the entity has obligation to pay cash. When entity has got obligation to pay cash, it is in the nature of debt. Therefore, 50,000 is liability, balancing figure, residual component 7,600 is in the nature of equity. Okay, now because the fair value of the equity option do not change, this 7,600 can be spread throughout easily 3 years. No change in number of employees also. But this 50,000 debt component, SAR component, cash component must be revalued every year according to its fair value. So for that we prepare this table. I repeat, equity portion I don't prepare this table because no change in number of employees because of the information, and no change in the, or you cannot account for change in the equity, no remeasurement. Therefore table is not required. I can simply do 7,600 divided by 3 per annum. Equity portion will get over. But for debt portion, fair value change must be given effect. So I'm preparing this table. Number of employees and the SAR per employee information not there. Together we know 1,000 employees or 1,000 options. Fair value per right at the end of the year 52. Total expense 1,000 into 52, 50,000. Vesting period 3 years. Closing balance how many years over? 1 year. So 1 by 3. What is opening balance? 0 opening balance. First year 0 opening balance. Balancing figure current year expense. Let me do second year, third year also. 1,000. Fair value per share changed 55. So total expense 1,000 into 55. 55,000. 3 years is the vesting period. No change happened there. And what is the closing balance? 55,000 into 2 by 3. 2 year is over. Opening balance is previous year of closing balance 7333. Balancing figure current year expense. Let me do for last year also. 1,000. Fair value per share 60. 60,000 is the total expense. 3 years over. Out of 3 years 3 by 3. Balancing opening balance 3667. Balancing figure current year expense 23,000. This is a format such a way that even if there are many changes. What are many changes? Number of employees can change, fair value can change, vesting period can change sometimes. Some problems are there where based on your average profits, vesting period can change. Whatever may be the variable, this table will consider it. Only job of yours is to understand this structure logically and keep practicing with it. You will get the right answers. In a short time, examination time management is also important. Just getting the answer is not sufficient. Consolidation tabulation format, ESOP tabulation format, in business combination, the steps format. So when you are used to these steps and formats, you can do faster in exams. That is how you save time in financial reporting paper. Not just by writing. Keep citing it. You may be right, but 3 hours time constraint is also there. Okay, this is not a test match. It's a T20 match. You have to finish within 3 hours. Okay, anyway, so don't spend time in writing. Please take a screenshot of this, and in the Telegram channel after the session, I will save it. I will share the screenshot solution. There also you can write it down, because we want to understand our focus should be on discussion, not on writing. Okay, but here one important aspect is whether settlement happens in shares or settlement happens in cash. How the joint is going to be happen, that is important, that we discuss now. Okay, so first year employee compensation expense to liability component 17,333 we calculated, and first year the expense on equity 2,533. How we got 2,533? 7,600 divided by 3. Simple amortization. Second year, we calculate the amount. Please forgive me for the formatting. And then expense again 2533. Okay, let me just do a quick formatting so that it looks better. Okay. Uh, you're asking, can we do combined JV for both debt equity? You can, but conceptually, I would say do it separately, because the concept wise, debt expense and equity expense are different. But for examination purpose, you can pass. They will accept it, but practically, conceptually, it's better to keep it separate. Okay. Now, so first year is over, second year is over. Similarly, third year also 23,000 and 2534 because of a balancing figure. Now comes the important point. If the settlement happens in equity, what happens? If the settlement happens in cash, what happens? On settlement year, scenario 1, cash alternative. If it is cash alternative, then you have 60,000, right? 60,000. If you add 17,333, 19,334, 23,333, that is our last column, total expense in the table. 60,000 is paid. So provision for liability to bank. But what will happen to this 2533 now? This is no longer valid, no longer required. So you don't keep it as share option outstanding. This becomes now free reserves, meaning this will be transferred to general reserve or retained earnings, other reserves basically. This becomes now free reserves. If it is settled on equity alternative, then what do? Then you have liability component and you have equity component. Both of them together will be transferred to share capital and balancing figure security premium. So ESOP outstanding 7,600, this number, and provisions for liability component 60,000. 2 share capital 1,200 shares are there, and balancing figure will go to security premium. Okay. Sir, we should record 50,000 debt initial value? No. 7,600 is not record initially. 50,000 is not record initially. Initially only computation. Only computation. Segregation only on initial calculation, only initial part. But the recognition of an expense for both debt and equity happens over a period of time. Only calculation happens initially, not transferred to P&L account. In this entry, stock option outstanding is only share-based payments reserve. Yes, correct. Yes, stock option outstanding is SBP reserve. You are right. And transfer to liquid, yes. Could you briefly explain the split of debt and equity component? Very simple. On the grant date, you have to split between debt and equity. How do you do? From the total consideration, subtract the debt element, remaining what you get is equity component. Total means the equity settlement number of shares into its fair value minus debt component means the cash settlement number of shares into its fair value. The difference, total equity minus debt, is the equity component. Same concept will apply when we go to financial instruments, where we do hybrid financial instruments, compound financial instruments, where we segregate into debt. From the total, subtract debt, we get equity. And If it is settled on cash basis, whatever was the equity portion will be transferred to P&L, will be transferred to retained earnings. Okay, let me see the thing. Can you explain the last entry once more? I'll do. In which case full liability is recognized in year 1. Full liability is recognized in year 1. Investing period is only 1 year. Yes. Okay. Fine. So I'll explain last entry once more. When the settlement happens on, when the settlement happens on equity, you will have liability component debited. You will have equity component debited. What should be the credit? Face value of equity share issued and balancing figure security premium. That's all. The difference between this and compound finance instrument, there are two differences. One, initially nothing is recognized, and second, in ESOP, that is the share-based payments, expense recognized over a period of time. That concept is not there in compound financial instruments. That is why principle-wise both are same, but the standard covers it separately. A financial instrument excludes Ind AS 102 for this reason. So debt component, equity component is recognized immediately in financial instruments, but recognized over a period of vesting period in share-based payments. But at the end of settlement, concept is same. In convertible debentures or in share-based payments, when settlement happens in cash, liability component is paid, equity component will be transferred to general reserve, other reserves, free reserves, other equity. And if settlement happens in equity, then liability account debit, equity component account debit to share capital to the extent of shares issued to security premium balancing figure. Can journal entry be passed in columnar format? You can. For examination purpose, they will consider it. But I would recommend only 1 or 2 entries, right? How much time you save by writing 1 or 2 entries? But if you want to write, you can. They will consider it. But some validator, I can't assure. But examination wise, reasonably, they should consider it. Okay, so this is about the share-based payments. Broadly, I have discussed. There are a lot of aspects. In detail, we can't go for it because we have done problems also. I hope lot of, at least to an extent, the concepts got clarified. Okay, we'll go to financial instruments. Before that, any questions on the topics we have done so far? Could you run through market and non-market linked at brief? Okay, there are two conditions. One is market conditions, performance conditions. In case of market conditions, at the end of the vesting period, even if the condition is not satisfied, you recognize in P&L account and then you transfer it to general reserve. That is market condition. Performance condition means you don't transfer it to P&L account at all. So if it is market condition, you transfer it to P&L as if the market condition is satisfied, and then you transfer it to general reserve, telling that it is market condition not satisfied, so it is transferred to general reserve. That's the main broad difference between performance condition and market condition. There is no initial recognition full liability in 102, it is there in 109. Yes, that is a difference, you are right. Correct. Okay, let's go for the bigger picture now. Financial instruments. Okay, financial instruments, there are three standards. One talks about recognition measurement, one talks about presentation, other talks about disclosures. First, we'll take presentation part, which has some definitions and all. Financial instrument means it's a contract, financial asset of one and liability of another or equity of another. Okay, I'll try to give some examples. Please don't take me as any wrong example or wrong person. Only for conceptual purpose, not any personal association. If your friend, who is a girl, let's say, is completely drunk and you have to take that person home, the person home. Now, is it your asset or liability? If the person is your girlfriend, it is an asset. If the person is your sister, it is your liability. Okay, only for example purpose, point I am trying to tell you is one person assets is other person's liability. One person's benefit is other person's cost. Okay, so forget about the example. Please don't remember it, because many students say that once things are over, class is over, you remember the example, you don't remember the concept. I don't want that to happen. Only for example purpose, take that out. Okay, somebody is asking, is share-based payment, that's all? Yes, share revision person, that's all I can do. If I keep talking about it, we can do 10 hours also, but we are having a time constraint. To give you overall idea, I have done the problem. That's all about share-based payments. Okay, anyway, so let us come back. Financial instruments, if you want to talk about it, means it has to be one person asset, it has to be one person's liability. Liability means there has to be two sides, double entry system. For every one action, there is equal and opposite reaction. For every one debit, there is credit. For every one asset, there has to be a liability or an equity, then only it is financial instrument. And more importantly, it has to be through contract. Contract need not be in writing, but it has to be a contract. For example, if you take an example of gold, gold is my asset, but nobody's liability. But if we take an example of bill receivable, it is my asset and somebody else's liability. If we take an example of equity shares, for a shareholder, it is investment asset. For a company, it is not a liability, but equity. So essentially, this is what you have learned in your accounting equation in CPT. Assets equals liability plus equity. But only one point is, it has to be through a contract. Asset of one person, liability of another, or equity of another. It has to be contract. For example, if I say income tax payable, is income tax a financial instrument? No. The answer is no, because income tax you have not done any contract to pay. So it's not a financial liability. There has to be a contract. If there is no legal obligation, income tax is a legal obligation, but the amount you have to pay to employees is a contractual obligation. Okay, let's go further. What is a financial asset? Financial asset is cash, equity instrument of another. You are having cash in hand, or investment in equity shares, equity instrument of another, or a right to receive cash. You have bank balance, fixed deposit, you have right to receive cash. That is also financial asset. Or another financial asset, you don't have right to receive cash, but you get one more cash. So if you have a sundry debtors, the person can give you cash, the person can give you check, or the person can give you bill receivable. Right to receive cash or any other financial asset, or exchange financial asset, which are potentially favorable in nature. Potentially favorable, because when something is favorable to you, then only it is called as an asset. If it is not favorable, it becomes liability. So potentially favorable is a financial asset. For example, let's say you have entered into a forward contract to buy at 48 rupees, and market price and the date is 50 rupees. That means what? You have saved 2 rupees or if you buy at 48, sell at 50, you can make a profit of 2 rupees. That's called as potentially favorable. If it's 50 rupees become 46 rupees, then 2 rupee loss, that becomes potentially unfavorable. And contract settled on own equity instrument. This portion of financial asset is not so much important, so we'll not discuss, but this portion related to financial liability becomes important. We'll discuss that. Financial liability means obligation to deliver cash. So if you have an obligation to pay in cash, it's a financial liability or another financial asset, or exchange any financial asset which is potentially unfavorable, or contract settled in own equity instrument. Contract settled in own equity instrument means, like, you have purchased raw material and the terms of the contract says you have to give them shares. So he's a creditor, you have to pay them, it's a liability, but instead of paying them cash, you're issuing them shares. Contract settled in own equity instrument, that is a financial liability. Now, one of the question I have seen in my Telegram channel also, that's a good one, I would like to discuss it here. Outstanding expense, is it a liability? Obligation deliver cash? Yes, it is a liability. Prepaid expense, is it a financial asset? When you have prepaid expense, or even say advance to supplier, insurance prepaid, in these cases you have benefit, no doubt about it, but how will you realize benefit? Will you realize benefit in the form of cash? The answer is no. When you provide advance to supplier, you have right to receive goods, not cash. The primary settlement intention is by getting goods, or even advance to employees, advance to suppliers. The benefit is to receive through goods, services. They are not financial asset. Whereas outstanding expenses means you are having an obligation to make a payment, therefore financial liability. Putting it other way around, outstanding salary is a financial liability, advance salary is not a financial asset. The settlement has to happen, or the obligation or the right should happen in cash. Okay, this is regarding financial liability. Equity instrument, balancing figure, asset minus liabilities, that is what is called as equity instrument. But we should also discuss on segment between debt versus equity. We'll come to that. Before that, let us take one quick question on the classification. You should have this question in your material. Please make sure that this is available with you. A cash, is it a financial asset? Yes. Let me just tick it. Cash is a financial asset. Deposit of cash? Yes. Trade receivable payable? Yes, it is financial instrument. Bill receivable payable? Yes. Inventories are not. They are physical assets, because you don't have right to receive cash, no contracts. Prepaid expenses I explained, not. Convertible debenture, variable number, I have to explain you this. Variable number means it is a financial liability, and fixed number means equity. I'll have to explain this in the next segment. I'll do it. Loan receivable payable is financial instrument. Gold is not, it's a physical asset. Fixed assets is not physical asset. You have right to receive cash? No, you don't have right to receive cash. Provision for tax is not, it's a legal obligation, not a contractual obligation. Advance from customer, not, because you have an obligation to give goods, not cash. Warranty obligation, in general it is not, because you have an obligation to replace the goods or repair the goods. But if a situation comes where you have to pay them cash, at that point in time it becomes financial instruments, but not in general. Derivatives, financial instruments, yes, that is also financial instruments. Any doubt in any of these points before we go to discussion on debt versus equity? Okay, let's go further now. Debt versus equity, you have to consider very simple point. Lot of points are there, but for exam purpose, keep it very simple. Number of shares. First of all, you check whether obligation to pay cash. Obligation to pay cash. Then it is always a liability if there is obligation to pay cash. Then you check whether it is fixed number of shares. If it is fixed number of shares, it is in the nature of equity. Variable nature of this is, let me call it as debt. Variable number of shares, you call it as debt. There are a lot of other points are concerned, but for exam purpose, for revision purpose, this much is sufficient. Options or forward contract at potentially favorable or unfavorable when to decide, as future price is unknown. At the end of every balance sheet reporting period, in the contract, you will have a contract price, compare it with the market price. If you have taken long position, let's say, if the market price is high, potentially favorable. If market price is less, potentially unfavorable. That's all. So depending on the market price at the end of reporting period, it may be become favorable, it may be unfavorable. Okay, so regarding debt and equity, there are a lot to discuss, but this much is sufficient. But let us go for one more portion, which is relating to preference shares. Preference shares, if it is redeemable preference shares means you have an obligation to pay cash, therefore it becomes liability. But if it's redeemable at the option of the holder can decide whenever redeem. Again, whenever he asks, you have to make a payment. You have liability to settle his requirement, liability. At the option of issuer means it is going to be a compound financial instrument. So basically, till the obligation is not there from the entity's intention point of view, it will be equity. The moment entity decides, okay, now I'm going to redeem it, then it becomes debt. Irredeemable preference shares, it becomes equity. Convertible preference shares, there is convertible component. You may convert, you may not convert. Therefore, it is a compound financial instruments. We have to segregate debt element and equity element. We'll do a problem on that. Dividend, cumulative in nature, entity has an obligation to pay cash, liability. Non-cumulative, till it's declared, if the entity don't have an obligation, it will be part of equity. Once it is decided, once it is declared, then that it becomes a liability. Okay, that is regarding the preference shares. Derivative element, derivative, three conditions to be satisfied. First condition, the value should change with respect to the underlying asset. For example, if you say option contracts, option to buy shares, option will change according to the shares change. When the shares changes, option value will change. That is derivative. Value will change with respect to underlying instrument. Initial investment should be either zero or minimal. So when you compare the options and its underlying asset share price may be 1000 rupees, but option price will be only 20 rupees. So either it will be zero or minimal as compared to underlying assets. Then settled at a future date. So you enter into a contract today, forward contract, future contract, options contract, or even swap agreement. They are entered at one point in time, but settled at later point in time. So three conditions are satisfied. These are all the examples. Future options, swap agreements are all the examples of derivatives. Okay, now as far as examination considered, how do you know whether it is financial instrument or not? Derivative, if it is settled on net basis, you please go for net basis means cash basis, then it is financial asset or liability. What is net basis? You have an agreement to buy some asset at rupees 45, but market price is rupees 50. So you don't buy it at paying 45, and you don't go to market and sell it at 50. Instead of 2 transaction, you receive the net amount directly. So what do you tell? Let's cancel the contract, give me 5 rupees only. Settlement on net basis, cash basis. It may be financial asset, may be financial liability. In my example, 5 rupee was profit, so financial asset. If the rupee was less, like 42 rupees loss, that becomes financial liability, potentially unfavorable. Initial investment is the option premium for derivative. Yes, that is true. You're right. Settlement on delivery basis. If your intention is to settle on delivery basis, then you have to check the nature of underlying instrument. If the underlying instrument is a financial asset, then this derivative is also a financial asset. If the intention is not to settle on underlying asset, that is to say, let me give an example. Agreement to buy a share. Agreement to buy a share. Share is a financial instrument? Yes. Then this derivative is also a financial instrument. If the agreement is not to buy a share, if it is to buy gold, oil, copper, non-financial asset, then it is not a financial asset. Very simple thing, my dear friend. Very simple. If the settlement is on net basis, close your eyes, underlying asset don't matter, it is going to be a financial asset liability because cash settlement. Cash is a financial asset. If the settlement is on delivery basis, you have to look at the underlying asset, because tomorrow when the derivative is settled, that underlying asset becomes your part of balance sheet. So if underlying asset is a non-financial asset, derivative is also non-financial in nature. If underlying asset is financial in nature, derivative is also financial in nature, because tomorrow on settlement, that underlying asset will substitute your derivative. So you should know if tomorrow what could happen, accordingly be prepared today. If that underlying asset is financial asset, you account this derivative also as non-financial asset. If the underlying is financial asset, derivative also should be financial asset when settlement is on delivery basis. If the settlement is on net basis, anyway cash, straight away go for derivative as financial instrument. This is about derivative. Compound financial instrument, where you have an equity element as well as debt element, like convertible debenture. Accounting is you have to calculate debt component and equity component. How do you calculate debt component? To the extent of entity has obligation to pay cash. How do you get the extent of obligation to pay cash? Debt element is to the extent of present value of obligation. That is, if you consider convertible debentures, what is entity's obligation to pay cash? Obligation to pay cash. Pay cash is, one is coupon and other is redemption value. Okay, these two things should be discounted, fair value purpose. And how do you discount? The discounting should not be convertible debenture discounting rate. Why? Because convertible debenture discount, the coupon rate has an element of conversion option also. It's a mixture, it's not pure liability. So don't use convertible debenture coupon for discounting. You have to use non-convertible debenture for discounting, because that non-convertible debenture coupon rate reflects pure liability, required rate of return. If a person has given a loan in the form of non-convertible debenture, only for the loan, how much return I expect is in the form of non-convertible coupon rate. Therefore, the convertible debenture coupons are cash flows. Non-convertible debenture coupon is considered as required rate of return used for discounting. I'll repeat once more. To compute the debt component, you have to do present value of future cash flows. Present value of future cash flows. Convertible debenture coupons, convertible debenture redemption price becomes cash flows. Becomes cash flows. Its present value means discounting rate. Discounting rate means pure lending arrangement, means convertible debenture. Therefore, the non-convertible debenture coupon rate is used as discounting rate. Convertible debenture coupon rate is cash flow. I'll repeat the thumb rule once more. Remember it. Convertible debentures coupon and redemption price is cash flow. Non-convertible debentures coupon rate is discounting rate, required rate of return. So many questions have been asked on this in the past in the exam. So we have to focus on this. We'll do a problem on also on this. Okay, so we'll do problem, but before that, any questions so far? Any questions so far? Callable and puttable option, how to treat? To see at whose option. Callable bonds means the entity can decide whenever they want, they can call. So till they call, it is debt. Once they call, once they make the decision to call, it becomes equity. If it is at the option of the holder, is what we're discussing now. Puttable means the holder will decide. Callable means the company will decide, and the puttable means holder will decide. If it is puttable instrument in the hands of the holder, I mean in the hands of the holder, whenever they want, they can sell it, they can convert it. We are doing now convertible debenture. There is a compound financial instrument. But if it is a case of callable bond, till the entity has the obligation, till the entity calls, it will not become a liability. Okay, let's go for the problem now. Please read. This is again a question from the recent MTP. D Limited issues preference shares to G Limited for a consideration of 10 lakhs. The holder has an option to convert these preference shares to a fixed number of equity instrument, fixed number, so equity component, anytime up to a period of 3 years. If the option is not exercised by the holder, the preference shares are redeemed at the end of 3 years. Preference shares carry a coupon of RBI base rate plus 1% per annum. The prevailing market rate for similar preference share without conversion feature or the issuer's redemption option is RBI base rate plus 4%. On the date of contract, RBI base rate is 9%. Calculate the value of liability and equity components. Okay, first thumb rule, you please write it down. Is for computing debt components, convertibles coupon on convertibles and coupon and redemption on convertible Coupon redemption on convertibles are cash flows, and non or coupon rates on non convertible are discounting rate. It is required rate of return. Let's do your regular format, that is year, cash flow, discounting factor, discounted cash flow. Year 1 to 3 years cash flow on non-convertible rate. Non-convertible rate is RBI base rate plus 9%. This is 9% is the RBI base rate plus 4%. 9 plus 4 becomes 13%. That is discounting rate. So discounting factor at 13%. Coupon rate, RBI rate plus 1%, RBI rate 9, 9 plus 1 becomes 10%. So coupon 10%, 10% on rupees 10 lakhs. That is 1 lakh. Last year redemption price redeemable at mark, nothing is there, fair value, face value 10 lakh. So discounting rates, $2.36. You can take 4 decimal, 5 decimals. Let me say I'll take 4 decimals. 2.3612. Is 2,36,120, and discounting factor 0.5428. Five lakh 42,800. 0.5428. 5,42,800. Okay, 3 years, sorry, 3 years. 0.6931. 931. Lakh 93,100. Total, this is debt components. 9,29,220. Then total proceeds is 10 lakh. Therefore, equity components, balancing figure 70,070. Okay, some of you telling buffering. Is it fine? I don't see any buffering here from my side. Okay, good. So all of you got this number, I think 70,780. Okay. Okay. So what will be the journal entry that you are going to pass? They have not asked. Let's do for our reference. Journal entry. Bank account debits 10 lakh. 2. This is preference shares. In brackets equity 7780 to preference shares debts, that is 9 lakh 29 to 20. So preference shares equity element goes to reserves and surplus. I mean, in other equity, under that we write it share capital. Preference share debt component will be shown under non-current liabilities. We will show under long-term borrowings. Now, how things will happen every year? Let me just show you the table. Okay, so every year opening balance we started with this, that is 9,29,220. This number will come. On that we charge 13% coupon rate. Coupon will come here. Closing balance, that is opening 929,220 plus 1,27,99 minus 1 lakh, that will give you the closing balance. Similarly, this 9,50,000 becomes opening balance for next year, plus on that 13% interest minus coupon, that becomes 9,73,000, and 9,73,000 521 next year plus 13% minus 1 lakh should become 10 lakh. But last year may not be 10 lakh because of the rounding off issues, so I'll do it as a balancing figure and I should get exactly 10 lakhs. This is how things are going to be there, and this closing balance is called as the amortized cost. So this financial cost is what goes to P&L, and closing balance is what goes to balance sheet, and this coupon rate is what actually shown in cash flow statement as financing activities. Now, can you do one thing? Can you give me the total of these two numbers? How much it will be? Total of these two? One was anyway 3 lakh. This is 3 lakh 70,780, and this total is 3 lakh. And what is the difference between these two numbers? And difference between these two numbers is what you are getting, the equity component 70,780, what we computed initially. Okay, so essentially what is happening, that my dear friends, if you had gone for non-convertible option, the investor expects 13% return, but because you went for convertible option, it is only 10%. You save that 3%. Why do you save? Because you are giving him conversion option. So the 3% savings you do, don't net it off. The 3%, what do you do? Expense you show higher and transfer it to other equity, because this other equity represents the value of conversion option. If you understanding the nature of options, call option, the writer has to receive premium. This is the amount which is received as premium. Anyway, now what will happen on the settlement date? Let us just quickly observe, just for understanding purpose only. After 3 years, if settlement is on cash basis, it can happen middle also, it can happen later also. So what will happen to the liability component, that is our preference share debt component? If settlement is on net basis, preference share debt component, you would have had 10 lakh by now, and you write to cash 10 lakh. What will happen to the equity component now? Preference share equity, that is 70,780 one thing we had, will be transferred to other equity or retained earnings or general reserve, whatever you call it, retained earnings, 70,780. Now if settlement is on share basis, then what would happen? The preference share debt 1 lakh is debited, and 2, we don't know what is the number of shares, how many shares are issuable for a fixed number of shares, we don't know the number. I really don't know the number, so let me just say whatever is the equity share capital face value, whatever to the extent of face value. I don't know the number, let us just take as 10 lakh only. And what will happen to this preference share equity portion was there, that will be transferred to securities premium, 70,780. So it can happen settlement on cash basis or settlement on equity share basis, or it can be combination of both. Okay, any questions so far? This is one of the popular questions asked in exam, financial instruments. So be very clear on this. Value of full compound instrument is always the issue price. Yes. What if the redemption is at premium? Then equity will be negative. No. Redemption will be premium means equity cannot become negative. When we take the cash flow computation, debt value, I will take not the face value, I will take the redemption amount. So when I do present value of that will obviously be less than the proceeds amount. So equity cannot become negative. Never. No chance. Okay. Any questions so far before we go to embedded derivative? That is one more component where I see lot of students have confusion. Any doubts so far? Is this security premium is equivalent to option premium? In this example, yes, both happen to be equal, but not necessarily always. If nothing is mentioned in the question, we have to present both ways of settlement. No, this is not required. I just showed you only for your reference. Unless they have specified the settlement or they have asked in the question, don't do this second part I did. Just compute debt component, equity component sufficient. Unless otherwise specified, don't go for settlement. Equity means fixed into fixed. So for classification of debt or equity, only number to be seen, or what if price keeps changing? You fix it for fixed, right? But in this case, it is fixed for fixed only, because you issue fixed number of shares, irrespective of what will happen in the market price in the market, you don't change the number of shares. So your fixed price will remain same, and number of shares also fixed. So for convertible debenture, it is always fixed for fixed. What should be done with the transaction cost with respect to equity and debt component? Transaction cost should be divided in the ratio of debt and equity, like what we calculated, and equity component will get adjusted with that expense, and for debt component you need to recompute the effective rate of interest. That is, what should be the present value of coupon redemption price, such a way that this comes to the present value of loan amount minus transaction cost. You have to compute the effective rate of interest for debt component. If number of shares is fair value, face value doesn't equal to the debt portion, where should balance get transferred? To security premium again. It will be equal to security premium. Transaction cost should be apportioned to debt and equity, fair value, and deduct from respective value, correct? And for debt, after deducting, you have to recompute effective rate of interest. Then only the value will be exactly equal to redemption value at the end of the maturity period. The effective rate of interest is required for debt component. Okay, any questions? Will be asked to compute IRR. No, FR paper, they will not ask you to compute IRR. They will be given in the question itself. If at all, if they ask, they will ask in the SFM. Practically, we don't compute. We have Excel. Excel, there are formulas which will give us the effective rate of interest. So in examination, in FR paper, they will not ask you to compute IRR. They will give it to you for sure. Any other doubts? Can we go further to embedded derivatives? Okay, let's go further. Okay, now embedded derivatives. Get the basic concepts right, then we'll go for the accounting part of it. What if the value of debt change? If the value of debt change, there is something called as extinguishment accounting. Recognition measurement will come to it in the next part. So please wait for that part where we discuss the recognition, initial recognition of financial asset and subsequent recognition of financial asset. What will happen? Those things we'll discuss in the next segment. Okay. As of now, don't worry about the changes. Fine. Let's go for embedded derivative. Please confirm. Okay, fine. Embedded derivative. The word embedded and the word derivative. Embedded means included, implicit, embedded, part of. So a derivative, not a standalone derivative, a derivative included, involved, implicit in an instrument is called as embedded derivative. For example, convertible debenture, convertible preference share, what we have just seen now. In that case, the holder has got the right to convert into equity shares. So the holder has got the right to get the share. A right to get the share is called as call option. So in convertible preference shares, there is an element of convertible preference shares, that is element of call option. There is an element of derivatives, that is called as embedded derivative. So many things will include embedded derivatives, that is clear. But should we separate it or not? That requires certain conditions. This example may not be accurate, but to understand the concept, you may get it. You have a mobile phone. You will get a cover. I'm sure a lot of people get some fancy cover, some Mickey Mouse is there, some cartoon character is there, some Avengers characters are there. So you are fancy about very things, you get the cover done. You like it, no problem. Let's say you are in Dubai. Now Dubai may not be a very fancy place, things are starting to coming down, but you know, earlier whoever is in Dubai means he is a rich person and they are mad about gold. Gold is cheaper in Dubai also. So there what do, you get one cover in gold, golden cover, not golden necklace, not golden ring, not golden whatever it is, but golden cover for your mobile phone. So within golden cover mobile phone, you have a mobile phone. So when you report in your balance sheet, will you show mobile separately, gold separately, or will you show gold and mobile? Okay, can you tell me which is more logical? I'm not talking about accounting part because both are non-financial assets here, but only for understanding the concept. So is it fine? Can I just say golden mobile, or you want to say gold value separately, mobile value separately? Correct. So if I reflect gold value, gold and mobile, that value will be correct. If I want to show gold separately and if I want to show mobile separately, in a way that is also right, because gold is not connected with the mobile. Gold value is different, mobile value is different. Gold value changes, mobile value changes for different reasons. It may be diamond watch. Many other examples can be given. Similarly, in case of option, in case of a contract, if it has a derivative element, should I separate it or should I show it together? That is the requirement. Okay, hope you got the basic concept of embedded derivative correct. Now let us look at the chart and then let us go to problem. Embedded derivative embedded in another contract. There is a basic host contract and derivative in host contract. So diamond watch or golden color, golden cover in mobile. So that is the host contract and the gold is the embedded derivative. Examples can be convertible bonds, importer and so on. Accounting, if you want to separate it, three conditions to be satisfied, that is different economic characteristics, existing comparable derivative, host contract is not measured at fair value. Let me give an example of these 3 points. Different economic characteristics. For example, what you have taken, convertible bonds. Convertible bonds has got debt component and equity component. Equity component means call option, the right to buy shares. Now, why will debt component increase? Debt value increase because of interest rate changes in the market. You know, bond valuation, YTM, coupon, duration, volatility. When the interest rate changes in the market, the value of the bonds also will change. But why will value of call option change? Not because of interest rates, because of market price. When the market price of the companies of the share changes, the call option value also will change. So one underlying is interest rate, other underlying is share price. Two different economic characteristics. That is the first point. Second point, existing comparable derivative. If you want to value call option and say fair value of call option is so much, you need to have a call option traded in the market. So for a private company, call option may not be there. Even for listed company, all call option may not be there. That is why. Then host contract is not measured at fair value. In our example, golden watch or golden covered mobile phone. If that is include the value of gold, then I need not show gold separately. If the host contract, basic contract includes the fair value, then no need to separate. If the host contract is not measured at fair value, then you need to separate because derivatives need to be accounted on fair value basis. What is the difference between derivative and embedded derivative? What is the difference between diamond and diamond watch? Gold and golden covered mobile phone. So one standalone basis is derivative. If the derivative is included in another instrument, that is called as embedded derivative. Standalone basis derivative, that portion if it is part of some other contract, that is called as embedded derivative. And it has to be accounted as fair value through P&L account. Okay, that is always derivative. Okay, let's do a problem which is there in the institute question and many people have doubt on this. That is there's one problem on exporter or importer problem. I would like to discuss that. But before that, any question you want to ask now? Is convertible bond, what is the host contract? Convertible bond is the host contract. In that, the option to get shares is derivative. If convertible bonds itself is measured on fair value basis, separation or is not required. Okay, let's go for the problem. Is it fine? Gold is the derivative in the golden mobile phone, where golden mobile is not fair valued. Yes, if golden mobile is valued on fair value basis, then no need to separate. If it is not valued on fair value basis, then you need to separate. But from exam point of view, they will give you whether need to be separated or not. You can expect only two kind of questions from exam point of view. One, a theory question on embedded derivative. What is embedded derivative? Give examples, and what are the accounting conditions? That is one theory question. Other one, what you are going to do one problem now, how to separate it, where they will give you that this is the embedded derivative, so you need to separate it. So if they give you problem, they will give it to you directly. Explain different economic characteristics. Let's say you have a operating leases, or you have to pay rental in foreign currency. Rental in foreign currency, what are the components of that? One, how or why rental will increase? Rental expense will increase because of inflation. One reason. Then when you pay in foreign currency, the foreign currency fluctuates. You have to pay it there. Therefore, operating lease or leases or rental payable in foreign currency, one component is inflation related to the lease, and other one the concept of the foreign exchange rate relating to the payable in foreign currency. One is connected with inflation, other is connected with the foreign currency fluctuations. Two different economic characteristics. Derivative is never at FET-OCI. No, derivative is always at FET-PL. We'll come to recognition. That is the next segment. Shall we go to the problem? Okay, let's go to the problem. I'll come to the explanation. Let me do the problem first. Let's read the problem. Entity A, an INR functional currency entity, enters into USD 1 million sale on contract of 1st January 2001 with entity B on INR functional currency to sell an equipment of 30th June. Spot rate on 1st January INR USD 45, spot rate on 31st of March INR USD 57. 3 months forward rate on 31st of March 2001 INR USD 45, 6 months forward rate on 1st Jan 2001 INR USD 55, spot rate on 30th of June INR USD 60. Let's assume that this contract has embedded derivative that is not closely related and requires separation. They have given in the problem clearly. Please provide detailed journal entries in the books of entity for accounting for such embedded derivative until the sale is actually made. Past journal entries. Okay, now first let us understand one basic concept. Okay, let's say A Limited entered into an agreement on 1st of Jan 2020, an agreement to sell at something, let's say rupees 50,000 after 6 months. So today you enter into an agreement to sell after 6 months at rupees 50,000. Okay, now as on, that is 6 months later, the goods market price in the market, okay, after 6 months happens to be 52,000, but you have committed an agreement to sell at 50,000. So when you pass an entry, debtor account debit to sales, can you tell me which amount will you write? You have entered into an agreement to sell the goods at 50,000 after 6 months. After 6 months, when the goods are actually delivered, when the goods are actually sold, the market price is 50,000 or 52,000. So will you account it at 52,000 or will you account it at 50,000? You have an agreement to sell at 50,000, but market price is 52,000. So when you pass an entry, debtor account to debit, debtor to sales, which amount you write? When goods are actually transferred. The answer is 50,000. 50,000. Some of you are thinking 52,000. If you write 52 here, can you tell your debtor pay me 52,000, market price 50? No. Then why the hell the contract was entered earlier? Contract was entered earlier so that the market price is not touched. 50,000. Okay. So whatever the commitment as per this, that is going to happen. 50,000. Okay. Fine. Now, instead of this numbers, let's say this transaction happens in US. It is $1,000 and now also it happens at $1,000. So what you are going to do? You are going to do $1,000. Okay, let me give an example now. This we will understand now. Get it? Please focus carefully. Pay attention. Let's say this is a transaction of buyer and seller, customer and supplier. You have sold goods to a foreign customer. Agreement, okay, not you are entered into an agreement to sell the goods later and receive dollars. And receive dollars. So goods you sell, dollars you purchase. Let's say as on date, the forward, okay, now this is, let's say, 1st Jan 2019 and agreement is for 6 months. Okay, agreement is for 6 months. As on this date, spot rate is 60 rupees and 6 months forward rate is 62 rupees. And I will say, let's say, goods is worth $1. Now here, please tell me what you have entered into an agreement. Remember, today you are not sold. Today you entered into an agreement to sell after 6 months. The cost of the product is $1. So as on today, tell me what is the value of goods? Means if you have sold this to a person in India, do you think you would have sold at 60 rupees or do you think you would have sold at 60 rupees? Please listen to me this question carefully and then answer it. If you entered into an agreement with Indian person in India to sell after 6 months, will you sell it at 60 rupees or will you sell it at 62 rupees? Contract, agreement in India. At what value you would have sold? In simple, in short, what is the value of goods? What is the value of goods in rupee terms? What is the value of goods in rupee terms? $60 or 62? Okay, many of you are telling 62, some of you are telling 60. 62 is right. 60 is wrong. Get this clearly. Remember, my dear friends, I am not selling it today. I am planning to sell after 6 months. I am not selling it today. I am selling after 6 months. And after 6 months, I know today the rate is 62. Today itself I know the rate is 62. So isn't that the value of goods is 62 rupees? So if I make a sale to a person in India, I will sell it at 62 rupees because I know the value of goods is 60 rupees. Not today, after 6 months. Is this point clear? My dear friends, I am not selling it today. I am selling after 6 months. I am not selling it today. I am selling after 6 months. So if I make a sale to a person in India, I will sell it at 62 rupees because I know the value of goods is 60 rupees. Not today, after 6 months. Is this point clear? Might be tricky, but this is the foundation point that you need to get before we solve the problem. If you sell it today, it is 60 rupees. You are not selling it today. Keep it in mind. I repeat, you are entering into an agreement to sell after 6 months. Therefore, the value of the goods should be considered based on 6 months rate, not spot rate. Value of the goods to be understood after 6 months rates, not today rate. Is that point clear? Some of you are still selling 60. I repeat once more, you are not selling it today. If you sell it today, 60 rupees would have been goods worth. You are selling after 6 months, goods worth 62 rupees. After 6 months, today I know goods is worth 62 rupees. So if I am selling it to a person locally also, I would have sold it at 62 rupees. Hope this point is clear. Is it clear this point? Okay, good. Now, this is fine. Now, after 6 months, the the rate happened to be 63 rupees. So, you will pass an entry debtor account debit to sales as per Ind AS 115 or as per AS 9 or as per Ind AS 18, whichever it is. Debtor account debit to sales. Can you tell me what is going to be the rate at which you book? 63 rupees or 62 rupees? What entry you are going to pass? Debtor account to sales, will you write 63 or will you write 62? Will you write after 6 months goods have been sold and on the date of sale the rate happens to be 63? Will you write 63 or 62? Okay, most of it is 62. My dear friends, logically you are right, conceptually you are right. Okay, no, but Gautam Ramesh, you are wrong. Sorry, sir. 62 sales as that the constellation expect to receive 115. No. Okay, let me tell you this. Let me give you clarity. The contract which I've entered is to sell goods. That's all, and receive $1. I never told that I will receive 62 rupees. That 62 rupees is not committed number. 62 rupees is not committed number. That is the expected rate as on the date of acquisition, not today. Today we receive $1, 63 rupees. So purely if I consider, I should write 63 rupees debtor account debit to sales, because as on date of sale, 63. Sir, 6 months back it was 62. You entered into an agreement? No, you did not enter into an agreement to sell at 62 rupees. Mind it, I repeat it, you entered into an agreement to sell at $1. You never committed for a price. You never committed for a price. You never committed for a price of conversion. You just committed for $1. But that is the thing. 6 months back, the rate was 62 is the value of the goods. Today, the goods has become 63. Now, the increase does not mean because of the goods has become more valuable. No, it is because exchange rate is different. Remember, value of the value of the contract is $1, value of the goods is $1, value of the goods is $1, but its rate changed. So you are expecting to receive 62 rupees, now you receive 63 rupees. The reason for increase is not because of the increase in the value of the goods, but because of the changes in exchange rate. Tell me how many of you understood this? Okay, now therefore what we should do, 63 is not the sale value, goods value 62, and we have to recognize a gain of 1 rupee. That gain of 1 rupee is because of you holding a foreign currency contract. You holding a foreign currency contract. Okay, now yeah, I will summarize it, don't worry. I will summarize it, don't worry. Now let us come to this contract clearly. What is this contract? I want an answer here. I'll ask the question, what is this contract? This contract is, I'm selling goods to the foreign customer and I'm getting dollars. I'm getting, let's say I'll sell 1000 units and the dollar price is, let's say, $1. Therefore, I should receive $1000. I will sell 1000 units and he will give me $1000. Is the point clear? The contract is, from my side, I will sell the goods and I have to get the dollars. In a way, we have had this contract. I'll come to it. Hold on. I'll answer that point later. My agreement is, I'm selling goods and I'm getting dollars. That's all the contract. I'm entering into an agreement to sell the goods where I receive dollars. From my side, the goods will be going out after 6 months and the dollar will come to me after 6 months. That's all. Is those two transactions very clear? I'm selling goods, getting dollars. Selling goods, getting dollars. I'm selling goods, getting dollars. Can I get some yes? Can you confirm it? Okay. Now, what is going to happen? This sales and getting dollars, can we separate it? Selling goods, make it as one transaction, and getting dollars, make it as another transaction. How does it look like? I am selling goods and I receive rupees. So I've separated, and I get dollars, I pay rupees. If I keep the transaction separate, I'm selling the goods to somebody else at rupee terms and I'm buying dollars from somebody else at rupee terms. No, Meena Srinivasan, I'm not told that agreement is at forward rate. Forward rate is in the market, what is trading. I'm not committing for a rate. I'm continuing the same example. But anyway, don't mix it now. First get the things right. I will connect everything. The goods which I've sold, let me separate it, and the dollars which I'm buying, let me separate it. This is called as separation. One contract is to sell the goods, other contract is to get the rupees, and this portion alone is called as embedded derivative. This contract is called as the host contract or basic, or let's say this is the host contract, and this is the basic host contract, which I'm separating it. So if I have to account for this portion to receive dollars alone as a separate contract, that is called as embedded derivative accounting. Okay, so as on date in the market, let's say in the market I'm telling spot rate is 50 rupees, or let's say 60 rupees, and 6 months forward rate 62 rupees. Please keep it in mind, these 60 rupees and 62 rupees are market, not committed in the contract, not committed in the contracts. And when you account on the settlement of sales, what do? You account for this goods, and what was the goods worth? 62 rupees. What was the goods worth? 62 rupees. And as on this date, on 6 months later, if spot rate happens to be 63 rupees, that means what? You have received 62 rupees, 63 rupees is $1, this difference 1 rupee is the foreign exchange fluctuation. Now this is a forward contract where as on standing date it would have been 62 rupees, but today it is 63 rupees. That is because of fluctuations in the rates, not fluctuation in the value of the goods. Gautam Ramesh, why? As the customer will pay in USD, he will pay in USD. I am separating it. That is embedded derivative. I am accounting for receiving the amount separately and USD separately. Selling the goods, one entry, one transaction. Receiving the dollars is one transaction. Selling the goods at the value of the goods, which I knew 6 months back. Getting the dollars, value of the dollar 6 months back. Today I settle it at spot rates. So I have to one agreement as two transaction, one sale of goods at original rate, and second settlement of receiving the dollars at one more rate. I'm not agreeing to sell the goods at 62, so how can I record the gain of 1 rupee? You did not account for selling the goods at 62 rupees, but you entered into in this agreement, you have an agreement to buy the dollars. What was the value of dollars you are expecting? In the agreement, you are getting the dollars. In the agreement, you are getting the dollars. That is forward contract to get dollars. Forward contract to get dollars. And forward contract to get dollars, what was your thinking? What do you think it was worth it? What do you think it was worth it? 6 months back, looking at today, you are thinking this is worth 62 rupees. But today it is actually worth 63 rupees. You thought the dollar worth 62, but now it is 63. So 1 rupee is exceeding your expectation. So 1 rupee is your gain. So 63 rupees the amount to be received as on date, where 62 rupees is allocable towards the value of goods sold and 1 rupee is towards the contract of receiving the dollars, where the fair value exceeded, the exchange rate exceeded, the derivative of the contract to get the dollar has changed. I hope people you got the clarity now. Okay. Now the question comes, for every transaction of export import, should I do like this? The standard gives you one guidance. They give it to you in variant sentences. I will give it to you in simple form. The standard says you should do like this. The standard says you should do like this only when the contract is a third party currency. Means what? Third party currency means this is rupees, functional currency, this foreign customer is dollar. If the agreement is in one of these two currency, this separation is not required. But if you account it for, let's say, pounds, which is a third party currency, not a functional currency of both the parties, then it requires separation. This typically happens in the let's say these Arab countries. When they sell oil, there is dirhams, ours is rupees, but we usually sell through dollars. Third party currency is involved, then you need to separate it. That is the accounting treatment, but in the exam they will give it to you. Okay, now let us solve this problem to get a clearer idea. Okay, now that as on, okay, let us summarize the rates now. Okay, first Jan 2001 spot rate, forward rate. As on 30th June 2001 spot rate, forward rate. Spot rate on 1st January was 45, and as on March is also there. Okay, 31st March 2001 and 30th June 2001. So 45 was the spot rate, and spot rate on March 31st is 57, and 3 months forward rate on 31st of March, that is 45, and 6 months forward rate on 1st of January is 55, and spot rate on 30th of June is 60 rupees. Presentation currency is relevant to determine separation. Yes, you are right. What is important is functional currency. Functional currency is the parameter to decide whether they need to be separate or not. Okay. Okay, is this table clear? Any doubts in this table? And last, this also will be 60 only. Okay, this is to entity A enters into a contract with B to sell an equipment. Let's say the equipment is the regular goods. So let's go for this sale contract only. Okay, so as on 1st of January, okay, let me, please tell me, is any of these rates mentioned in the contract? Is any of these rates mentioned in the contracts? As per this problem. Okay, none of these rates are mentioned in the problem, but all of these rates will be used only for accounting purpose. Okay, for accounting purpose I'll account all these things. Okay, now what I'm going to do, as on 1st of Jan, no entry is passed. As on 1st of Jan, no entry is passed because there is no cash flow happening. You just enter into an agreement to sell the goods. to sell the equipment. Okay, so no entry on 1st of Jan. Then on 31st of March, this derivative, okay, now one thing has to be clear in this case, in this contract also. What is this forward contract? Okay, this is contract to sell goods. This was the original contract, but I broken down into two parts. This part is contract to sell goods, and I'm dividing to receive and receive foreign currency. Now receive foreign currency means, can you tell me whether it is forward buy contract or forward sell contract? Implicit, notional, not actual, not actual, notional, notional. I'm receiving foreign currency. So forward buy contract notional or forward sell contract notional. I'm getting answer as forward sale contract, forward sale contract, forward sale contract, forward sale contracts. I repeat my question once more. Please focus only on this portion where I am getting dollars. I receive dollars. Receiving dollars, receiving foreign currency, is it a buy contract or a sell contract? Receiving dollars. Receiving dollars. Implicit, notional, I'm receiving dollars. Dollars coming into me. Dollars coming in means buy or sell. Don't look at the original contract. Original contract is to sell goods. I'm not talking about it. But once you sell goods, you get foreign currency. Think from currency point of view. Think from receipt point of view. Think from dollar point of view. I think now you get it. You are getting it. Dollar is coming in. Dollar is coming in. Notional forward buy, dollar will come in. Okay. Now once you come dollar, what you have to do? You have to sell in the market. Once you receive dollar from the customer, you have to sell in the market. Then only rupee will come to you ultimately. Right. Now this forward contract is notional. In notional, you get dollars. Once you get dollars, actually you have to sell dollars. At what rate I'm going to sell, which I don't know. Therefore, this situation, hedging is not done. Hedging is not done. Are you getting that point clear? In the contract, in the sale contract, I get as notionally forward buy contract where I get the dollars. Once I get the dollars, okay. I'll repeat once more. Okay, I'll repeat once more. In the contract, from the customer, I will receive dollars. Okay, let me repeat once more. I think there is some disturbance there. Let me repeat once more. In the contract where I sell the goods, I get the dollars. Dollars once I receive, I have to sell it in the market. So my position is still unhedged position. I have not done hedging because nowhere I committed for the price. My contract does not mention the rate. My contract does not mention the rate. So my position is still unhedged. My position is still unhedged. I still have risk. Is it fine? Okay. Now on 31st of March, you have entered into a notional forward buy. At what rate you have notional entered forward buy? Or 55 rupees. But in the market now what is happening? 45 rupees. So 12 rupees you have lost it. 57 rupees became 55. So 12 rupees you have lost it. Entry will be loss account debit to derivative liability 10 rupees, sorry, 10 rupees is the loss. Because you have notionally entered into a contract to buy at 55 rupees and in the market it is only 45 rupees, so you have to enter into a loss. On 30th of June, this 45 became 60 rupees. Now you are getting a profit on derivative liability. Therefore, you are going to do derivative liability account debit 10 rupees. You reverse it and then you account for the change 5 rupee profit, that is derivative asset account debit 5 rupees to gain, that is going to be total 15 rupees. I'm yet to pass the entry for the sale, but is this entry clear? On 1st of January, no entry. On 31st of March, notionally you are going to receive 55 rupees. You are entering into contract to receive the dollar at 55, but the dollar is now 45. Therefore, 10 rupee you have lost it. And then it became 15, so 15 rupees you have gained it. So 15 rupees gain. Is it fine? Then on 30th of June, you have to pass an entry, debtor account debit to sales. At what rate you are going to pass? You are going to pass original sales entry, which is 55 rupees. Then what will happen to derivative asset? You transfer debtor account again. So debtor account debit 5 rupees to the derivative asset 5 rupees. Can you please tell me whether I should explain any of this journal entry now? So accounting for derivative only on each reporting date and date when goods are transferred. Yes, you are right. Okay, let me pass the entry in a slightly neater format so that it looks neat. That's clear also. I'll just pass one more, I'll just write it fresh. On 1st January 2001, no entry. But remember, what is the transaction here? The transaction is agreement to sell goods at agreement to sell goods and receive USD. So after bifurcation, after okay. Okay. I think things are fine now. Can you please confirm? Okay, good. Okay, I have not talked anything in the last 5 minutes. I've just given the list of journal entries. You can write it down. You can take the screenshot. Okay. I think we have spent quite a much time on this. Let's go further. Please take a screenshot of this. I'll share it on the Telegram group also later. Okay, let's go further. Now let's go to classification of financial assets. So for classification of financial assets, you have to check on contractual cash flow test. Contractual cash flow means, does it comprise solely for the purpose of principal and interest? It should be a lending arrangement. Like in case of trade receivables, bills receivables, bank deposits, principal and interest. If you invest in equity shares, that is not principal and interest. So it should only comprise of principal portion and interest portion and nothing else. The second test to be considered is business model test, that is the intention. Business model test means intention of the company, the entity, whether you receive the money through collection or through sale. For example, you have debtors, you can wait for them to pay you the money, or you can do something called as factoring. Bills receivable, you can do something like either you receive the money or you can endorse it to somebody else. So you can collect it or you can sell it. So there are varieties, three varieties. Amortized cost means you first check for contractual cash flow test. So if it is in the nature of principal and interest, then it is called as amortized cost, and business model test should be intention to collection, not sell. But if contractual cash flow test is satisfied, principal interest is correct, but intention is either through sale or collection. Both might be there. It might be collection or sale, but amortized cost means collection only. You are not intending to sell. But FET means you may sell, you may hold. Like if you have investment in bonds, your intention is I'll keep on receiving coupon, but if good price comes, I'll sell it off. Then it is FET or equity instruments classified as FET there is no condition attached. It is a straight away irrevocable option. That is, when you buy the share, you classify it as FET later you cannot take it back. When you will classify, that is left to you. If you classify as FET you have to continue it forever. The standard don't give any conditions. It gives you the choice for you to take it at FETPL or at FET and rest everything come in FETPL. Derivative comes here, held for trading and all will come here. This is classification of financial assets. Next, financial liabilities are mostly the derivatives, held for trading, contingent consideration, continuing involvement, all these comes in FETPL. Rest everything will come in amortized cost. So some of you are asking, in the debt component, in the problem we solved earlier, if the debt value changes, should I change it? Answer is no, because amortized cost. Even here, when you have investment in bonds, if the market value of the bonds change, should you account for it? No. Why? Because when your intention is to hold till maturity, short-term fluctuation don't matter, because intention is not to sell. If your intention is to sell, sale price becomes relevant. If your intention is to hold, sale price is not relevant, therefore market value changes is not going to affect amortized cost financial asset, not going to affect amortized cost financial liabilities. Okay, so these are the things on classification. Let's come to recognition portion. The element what we discussed, amortized cost, FVTOCI debt or FVTOCI equity and FVTPL. Initial recognition will be at fair value. There is one discussion, I'll take it up afterwards. Transaction cost in the amortized cost, it will be added to the fair value and therefore effective interest rate is recalculated. For FVTOCI also added, but for FVTOCI equity also added, but for FVTPL it is transferred to P&L. Anyway, it will be transferred to P&L. Subsequent recognition in amortized cost, you will recognize at amortized cost basis. In FVTOCI, valued on fair value basis. In equity also valued on fair value basis, and FVTPL also valued on fair value basis. Income recognized at, in case of amortized cost, it will be transferred at effective interest rate, like the way we did one problem, no, debt equity component, how interest is calculated, effective interest. FVTOCI, fair value change transferred to P&L. FVTOCI equity also, fair value change to P&L. FVTPL is transferred to P&L account. So it's transferred to OCI, whereas in FVTPL transferred to P&L account. There is a major difference. Interest received, dividend received in amortized cost. Anyway, effective interest goes to P&L, so interest don't go to P&L. FVTOCI will go to P&L, dividend received or interest received, coupon received, and all will be transferred to P&L account. Derecognition, amortized cost, any difference between the settlement amount and the book value is transferred to P&L account. FVTOCI with recycling to P&L. I hope you know what you mean by with recycling. We have discussed at the beginning itself. But if it's FVTOCI, it is without recycling directly to other equity. There is retained earnings. And then FVTPL, the difference will be transferred to P&L account. This is the complete picture of financial asset recognition summarized in one sheet. You can take a screenshot. I will share it in the Telegram group also later. If you have any question, please ask. Gautam is asking, sir, value never changes because we receive only USD and change in due to exchange rate fluctuation. You are right, my dear friend, you are right. The value of goods don't change, so that we are not going to do any change. But any change that happens that is due to the exchange rate, that is what we accounted as derivative. Yes, you are right in the embedded derivative. Any doubts here? Why fair value transferred to P&L in case of FVTPL? Because the name itself is FVTPL, my dear friend. So it is transferred to P&L account. And FVTPL are primarily held for trading purpose, short-term purpose. So when the fair value changes, your intention is to trade, that should be reflected in the P&L account. Okay, is it fine? Can we go to liability? Okay, why? For transaction cost, I will go to P&L account. Because even if you add it to fair value, it will ultimately go to P&L account only, my dear friend. You see, suppose the fair value was 100 rupees, transaction cost is 2 rupees. And year end, fair value became, let's say, 108 rupees. Now, what I am telling, take 2 rupees to P&L and difference 8 rupees to P&L, net effect 6 rupees to P&L. Even if you add 100 plus to 102 and 102 and 8, that means 6 rupee only will go to P&L. Impact is same only. That is why directly transferred to P&L account. So income recognized in case of FETOCI, what is the accounting entry? If it is a gain, financial asset account debit to FETOCI reserve within brackets OCI. Okay, let me go further. Okay, this one thing you have to understand. In FETOCI, interest is on EIR. No, EIR comes only in amortized cost basis. The concept of EIR don't apply to FETOCL. Name itself is fair value. No. Why will you go for effective interest? Fair value change is what FETOCI. No concept of EIR in FETOCI. Okay. Let's go to the one important point. Initial recognition. Transactions at market terms means fair value is equal to transaction price. So normally when you purchase goods or invest anything in the market, it will be at market price. But sometimes transaction need not be at market price. When it can happen? When employer gives loan to employees. When you're purchasing the goods from holding subsidiary company. When you're investing, giving the loan to holding company. So in these cases, things may not be at market terms. There might be some involvement. In such case, we have to separate the fair value and transaction price. And fair value will usually be equal to present value of the cash flows. And difference between transaction price and fair value, if it is employer-employee relationship, you may say staff welfare expense advance amortized over number of years. Landlord and tenant, you pay advance, right? Then you get the deposit back. In such case, you will treat as advance lease rental, ROU asset. Parent subsidiary, like parent gives the loan to subsidiary on a concessional rate. Why will they give loan at a concessional rate? Because they want to control subsidiary. So you treat as like an investment in subsidiary in the nature of equity. Subsidiary gives it a parent, loan to parent. So subsidiary don't invest in parent. Why will subsidiary give loan at a concessional rate? That is in the form of a dividend. Instead of receiving dividend, holding company, they get the loan at a concessional rate. And government grant in days 20, you know, when the government gives you loan at a concessional rate, the balance there we treat as government grant. The difference between the actual amount received and its fair value. Okay, let's do a problem now. Question number 2. Again, MTP question. Blueberry Limited entered into a following transactions during the year. Enter into a speculative interest rate option costing 10,000 on 1st of April to borrow 6 million from Exxon Bank commencing from 30th of June 2002 for 6 months at 4%. Enter into a speculative interest rate option costing 50,000 premium on 1st of April to borrow 6 million from Exxon Bank commencing from 30th of June for 6 months. The value of the option on 31st March 2002 is 15,250. So 10,000 is your cost, 15,250 is the value. Purchased 6% debentures in Fox Limited. Their issue date is 1,50,000. An investment in Blueberry. Intends to hold the debenture until redemption at premium in 5 years time. Effective rate of interest is 8%, amortized cost. Purchased 50,000 shares in Cox Limited on 1st of October, 3.5 as each of investment. The share price in the year end is 3.75. Show the accounting treatment and relevant extract in the fund statements for the year end March 2002 for transaction related to financial instruments. Blueberry Limited recognized financial asset at fair value through P&L only when this is unavoidable. Difference in landlord, is it not security deposit? Yeah, that the security deposit is, you have to record it, not the amount given, you have to record it at the fair value of the deposit. if the deposit amount is 1 lakh, its fair value is 90,000, 10,000 you need to account it as an advance. If it is lease satisfying, that will become ROU asset. Difference goes to P&L or state line basis. That depends on the nature of the agreement. Like government grant goes to P&L in the proportion of benefits transferred. Staff welfare expense, proportion of the benefit received from the employee. If it is the lease rent, yes, if you follow ROU asset, if you follow the state line method of depreciation, equal. If you follow WDV method of depreciation, accordingly. So I can't concludingly say only state line method, depending on respective treatment. Okay, let's pass journal entry now. Okay, they have not asked journal entry, but let us do it for our reference. First one is about enter into speculative interest rate option. Speculative interest rate option means obviously they're held for trading, and held for trading means fair value through P&L account. Derivative for trading purpose, speculation. Therefore, it has to be FVTPL. Anyway, journal entry is financial assets, that is interest rate option, 10,000 to cash or bank, 10,000. And remeasured at year end value is 15,250. So same financial assets, 5250 to P&L. Then 6% debentures, but intention is to hold till maturity. So if amortized cost, financial assets, debentures, intention is to hold till maturity, so amortized cost. So cash, on first April, is it assumed transaction cost is fair value? Since it's fair value, in general, unless specified, we assume transaction price is fair value. Only when it is not in market terms, we go further. Here and all, no question of it. So financial assets to cash, 1,50,000. Then On 31st of March, then amortized cost basis, financial asset debenture, you record it on effective interest base. Effective interest is given as 8%. So 8% on 1,50,000 means it becomes 12,000 to P&L, 12,000, and you receive coupon that will be transferred to cash account. You receive coupon at the rate of 6%. Then cash account debits 9,000 to financial asset. The coupon receipt 9,000. Then last one, shares in Cox Limited. They said they designate fair value at fair value through P&L only when this is unavoidable. If it is avoidable, they'll go for other things. So in equity shares, you have one time irrevocable option of classifying it as FET-OCI. So here we will classify it as FET-OCI. Therefore, entry will be financial assets, yes, one lakh 75,000, 3,000 into 3.5. Then remeasurement, 50,000 into 3.75 minus 1,70,000. That is 2 financial assets, yes, 2 FP OCR reserve or FPT OCI. We go to OCI 12,500. So could you repeat why shares is in 4 of FPT OCI? Because they said in the problem they will take it to P&L unless it is unavoidable. Unless it is unavoidable. So they don't want to go to P&L unless they force into it. So if they have other choice, they will go for other choice. Equity shares can be classified as FET-OCI. That option is there in the standard. Therefore, they will go for it. Unless it is unavoidable, they don't go to P&L. If it is avoidable, they go to other things only. So equity shares can be classified as FET-OCI, that is given in the standard, so you transfer it to FET-OCI. So that is the question regarding this one. And balance sheet, obviously whatever the asset values, all these things will come in the balance sheet. Okay, let's go to the next one. This is a typical question, has been asked in the exam quite a few times. Comfort Limited granted rupees 10 lakh loan to its employees on 1st Jan 2011 at a concessional rate of 4%. Loan is to be repaid in 5 equal installments along with interest. The market rate of interest for such loan is 10%. Following the principle of recognition measurement in financial instruments, record the entries for the year ended December 2011 for the loan transaction and also calculate the fair value of loan initially to be recognized and amortized cost for all the subsequent years. FET-OCI balance at the year end goes to retained earnings. Yes, FET-OCI also goes to retained earnings. P&L also goes to retained earnings. Whatever the surplus will be shown in retained earnings. That is other equity. Other equity. It will be shown in other equity. Okay. So this is a very important question from exam point of view. They have asked this question so many number of times. This is a situation where the transaction price is not equal to fair value, because if it is fair value they would have given the loan at 10% per annum, but because they are giving loan only at 4% per annum, transaction is not in market terms. In such case you have to compute fair value and market value difference, you have to treat it in some way, and here because it is related to the employees we will treat it like a staff advance or a staff employee benefit advance, and we amortize over a period of number of years. Then this fair value, how do we compute? Present value of future cash flows. What are cash flows? The amount which you collect from the employees. How do you get that? 10 lakh over 5 installments plus interest. Let's calculate that. So 10 lakh by 5 installments, 2 lakh plus 4% on 10 lakh means 40,000, 2 lakh 40,000. Next 2 lakh is repaid. So balance how much will come? On 8 lakh 4%, 32,000 plus 2 lakh, 2 lakh 32, like the 2 lakh 24, like the 2 lakh 16, 2 lakh 8. Discounted at 10%, present value you get. But amount of loan is 10 lakh. So 10 lakh minus 8 lakh 54, you treat it as a staff advance or a prepaid staff expense, will be amortized later. This is the initial entry. Please take a screenshot. I'll share the solution also so that you don't spend time in writing it down. We can discuss further. Okay, now amortization schedule, we have done amortized cost. Opening balance is 8 lakh 54. On that you charge 10% interest, 10% interest, and the amount you receive first installment 2 lakh 40. So 8 lakh 54 963 plus 85 496 minus 2 lakh 40 goes to closing balance, and this financial income goes to P&L and closing balance goes to balance sheet as financial asset. Now 7 lakh 459 becomes opening balance. On that you charge 10% minus 2 lakh 32 next installment. You keep on do. Last fifth year it is 0, and balancing figure you compute as finance income for the purpose of tallying it clearly. Okay, I think we have discussed quite a few things now. Two portions are pending. One is derivative accounting, other is hedge accounting. I would like to spend some time, maybe about half an hour, but I think you have some more class also. I don't want to squeeze in between. Let's do one thing. Today we'll stop at this point. We have to do financial instruments relating to the hedging, and hedge accounting, of course, and derecognition. So these two parts will take it up tomorrow. But if you have any other question for today's session, please ask. Here amortized cost as intentions to collect and contractual cash flow test. Yes, it is amortized cost because intention is to receive the money by whatever the loan you have given to them. Not, you are not going to sell this loan to anybody else. So in general, lending arrangements are amortized cost. If you have any questions, you can ask. Tomorrow, our target will be once we do this tomorrow, we will focus on Ind AS 115, 116. So old syllabus student can join for initial few months, a few minutes, then you can listen 115, 116. But our focus is once we do financial instruments, I'll go for Ind AS 115 and 116. Sir, embed derivatives, could you please once again clarify the notional forward by contract, only that if it is repeated. No, I'll repeat. How many ever times you tell, I will repeat it as long as you understand. That's all my intention. So I'll just summarize that part. When you enter into a forward contract to sell goods, there is an implicit forward contract to buy currency. When there is a forward contract to sell goods, there is an implicit forward contract to buy currency. Goods sold, currencies are purchased. Now, when you account for the sales, it will happen at original sales forward rate existing on the agreement date. Subsequently, any changes in the forward rate, you are not going to affect sales, you will affect only the forward contract to buy what you had, the fair value change in derivatives. That is what I would like to point it out. To embed derivative, you account for the sale at original forward rate, and difference between original forward rate and the rate at the time of sale, actual sale, the difference between those two, don't call it as sales, you call it as fair value change in derivatives. When there is a forward sale contract for goods, there is implicit forward buy contract on currency. This is not hedging. This is implicit forward buy contract. Similarly, if you have a contract of forward contract to buy goods, there is an implicit contract to sell goods. Or if you want to remember one shortcut, you can remember it is the opposite of hedging. Whatever you do in hedging, opposite you do it here. That is a shortcut. Yes, you got 25. That is what happens, but I told you. This is not hedging. And one more point, if I have to tell you regarding the hedging, what do you do in hedging? Hedging means there is a risk which is created and risk you avoid it. That is hedging. There is a risk and you minimize risk. To minimize risk, you go for hedging. But what is that risk is created? We are accounting for that. The purpose for which hedging is done, no. The reason for which hedging is done, risk is created. That risk accounting is what we are doing in embedded derivative. Why will we go for sale in hedging? There has to be a buy, right? That buying, we are giving the effect. I've never done Ind AS 115. Is it advisable? Yes. It will be a good revision part. It's a very quick, compact revision. Definitely you can attend. Even for old syllabus students, if you want to know what is Ind AS 115 on a summary basis, it is good. Even 116. Okay, hope all of you got the clarity then. We have extended 15 minutes yesterday, before the session, and 15 minutes now. So like this we will compensate. So we'll stop at this point. See you tomorrow at same time, 10:45. Till then, I will release the MCQ question. Link will be given in the channel, Telegram channel. Please join and please take the MCQ test. Definitely today MCQ test will be very, very relevant as far as conceptual clarity on financial instrument is concerned. Okay, so we'll see you tomorrow at same time, 10:45. Till then, take care, enjoy learning. Thank you. See you tomorrow at 10:40. Bye bye.